Welcome to the Deep Dive. Today, we're diving into Marti Technologies, ticker MRT. We're putting on our talk tickers hats.
Yeah, let's do it.
We're going to really tear apart their H1 2025 earnings call. This is the Turkish urban mobility company.
One that's basically reinvented itself in the last year or so.
Exactly. If you've been following Marti, you know the big story is this massive strategic shift. They moved from just, scooters and bikes towards really aggressive ride-hailing. And they only started actually charging for that, monetizing it, back in October 2024.
So these H1 results, they're kind of the first big test, the first real report card on how that massive pivot is actually working out.
Right.
And what that report card shows is?
Well, it's fascinating. There's this real tension, Marti's hitting incredible scale operationally. I mean, they're really dominating their home market. But, and this is the crucial part, they are making a very deliberate choice not to maximize profit right now.
Exactly. Choosing market share, pure market capture today over, ringing the cash register as hard as they could.
Okay, let's unpack that choice then, starting with the headline figures. H1 2025 revenue
came in at $14.3 million.
Okay. And how does that compare?
It's strong. A 70% year-over-year jump. And management is pretty clear that acceleration is almost entirely down to switching on the ride-hailing revenue stream.
Makes sense, as the engine's firing on the top line, but what about the burn? Adjusted EBITDA.
Yeah, that showed some real improvement, actually. The loss narrowed by 47% compared to last year, came in at negative $6.0 million.
Still a loss, but moving in the right direction, significantly so.
Definitely.
But then there's the big JAP net loss number. That was, what, $19.3 million?
$17.3 million, yeah.
So for listeners trying to square those two, the negative 6 adjusted versus the negative 19 gap.
Yep.
What's the simplest way to think about that gap?
Okay, think of it like this. The $19.3 million loss, that's the big official accounting number. Includes everything, all the non-cash stuff.
Like depreciation on scooters, stock comp.
Exactly, stuff like that.
Yeah.
But the $6.0 million adjusted EBITDA loss, that's what management really wants you to focus on. It strips out those big non-cash expenses.
So it's closer to the actual operating cash burn.
Precisely. It shows the day-to-day cash burn rate is much smaller than that big headline gap number suggests. And look, the market knows they're investing heavily right now.
And those investments are clearly buying scale. I mean, the operational numbers behind that revenue growth are pretty staggering.
They really are. They're building that network effect incredibly fast. Unique ride-hailing riders, they more than doubled. Hit 2.28 million.
Wow, double.
Yeah, that's a 107% year-over-year jump. And drivers are keeping pace too. Registered drivers up 92% to 327,000.
Huge growth on both sides of the market.
And total rides across the whole platform, including the older stuff, were 19.2 million, still up 41%. I mean, these numbers basically confirm Marti is becoming the default ride-hailing option in Turkey.
It sounds like it.
But what's really interesting, though, is how the market reacted, or rather how it didn't react. Despite doubling the rider base, these huge growth numbers, the stock price barely moved, just a little bump, like 1.3% on the day of the call.
Huh. So investors see the growth, but maybe they're still waiting.
I think that's exactly it. It signals they acknowledge the scale, the execution, but they're still a bit hesitant about that profitability switch we mentioned. They want proof it can work in the new markets too, maybe.
Which leads us right into the strategy piece. Management called 2025 a pivotal year. It sounds like it's all about city expansion now.
Absolutely. They're positioning themselves, and this is a quote, as the only ride-hailing operator at scale in Turkey.
That's a bold claim, especially in a market that, hasn't historically had these big tech mobility players like we see elsewhere.
It is bold, and they're backing it up with action. A real land grab. In just the first 6 months of 2025, they launched ride-hailing in 6 totally new cities.
6 new cities in 6 months.
Yeah, which basically increased the population they serve by 1.5 times. They're now in 10 cities, covering roughly half the entire population of Turkey.
Okay, but here's the really critical strategic point, right? The thing you have to understand about those 6 new cities,
Go on.
They launched service, but they are not monetizing them. Not this year, anyway.
Correct. 0 revenue from those new cities in 2025. They're running them purely as a cost center.
Pure market share grab.
Pure, unadulterated market saturation. They're taking a definite short-term financial hit to lock up the drivers, lock up the riders, before maybe a big global competitor even thinks about entering.
And that takes people. They mentioned team growth.
Oh, yeah. The ride-hailing team itself is set to more than double just this year. From 120 people at the start of the year to, they expect 260 by the end.
That's a massive operational lift. Are they just throwing bodies at it, or is there an efficiency angle? Management talked about tech investment.
Yeah, they're trying to scale smart.
Yeah.
They mentioned introducing a new AI engineering department.
AI. For what specifically?
Primarily for optimizing the matching, connecting riders and drivers faster, better, and also dynamic pricing.
Makes sense. Trying to avoid those common frustrations, like a driver accepting then immediately canceling after asking the destination.
Exactly. Things like that hurt the experience. And they said this tech focus is already paying off a bit. A big app redesign, focus on ride-hailing, apparently led to a 2% increase in the request-to-ride conversion rate.
Okay, that's a tangible metric. Better efficiency leading to more completed rides.
And engagement's up too. Weekly active users up 16%, monthly up 12%.
Now, one claim from management that really stood out to me was about driver supply. They said they face no constraints whatsoever onboarding more drivers. None.
Yeah, that's ambitious.
They expect to hit 450,000 registered drivers by the end of the year. I mean, in an economy with high inflation, regulatory stuff, isn't that a huge assumption? No constraints at all.
It definitely sounds ambitious on the surface.
Yeah.
But their argument is that the network effect is now so powerful it's sort of self-fueling.
More riders means more money for drivers.
Which makes it easier to sign up more drivers. Exactly. They actually claimed the pace of new driver signups is accelerating.
Okay, if that holds, it's powerful. What's the rider target for year end?
3.3 million riders. If they hit both those numbers, 450K drivers, 3.3 meter riders, and then that no constraints claim starts looking pretty prophetic. Okay, let's switch gears slightly to the unit economics, because this shift to ride-hailing, it's really helping clean up their cost structure.
How so?
They saw a big drop, 25% year over year in their total cost of revenues.
Why to drop?
Two main reasons. First, the mix shift. Ride-hailing just has higher margins naturally.
Yeah.
Lower asset costs, less depreciation, less maintenance compared to owning and managing a huge scooter fleet.
Right, fewer physical assets to worry about per ride.
Exactly. And second, they also ran some efficiency projects on the remaining two-wheeled EV fleet. Put those together, and their gross profit margin jumped by 49%.
49% improvement in gross margin. That's huge. Okay, but then let's look at G&A. General and administrative expenses were up 35%. That sounds more like expansion bloat.
It does on the surface, yeah. But you have to unpack that 35% spike. A really big chunk of it, $4.7 million, was non-cash share-based compensation.
Ah, the stock for employees again.
Right. If you pull that non-cash hit out, the actual cash G&A only went up by about 13%.
Okay, 13% makes a lot more sense given they're doubling the ride-hailing team size. That aligns.
Much more manageable, yeah.
Now, let's get to the absolute core issue. The elephant in the room on this earnings call. Take rates.
The magic lever.
The magic lever they're refusing to pull, apparently. Management confirmed they're still operating in the high single digits as of H1.
Yep, still very low.
Yeah.
This is the handbrake they are consciously, deliberately keeping engaged.
So what's the stated strategy there? Just wait.
Their argument is basically, we have inelastic demand right now. We're the only big player. We could jack up take rates tomorrow, say, to 15 or 20%, and probably hit profitability pretty quickly.
Because riders and drivers don't have many alternatives.
That's the claim. But they explicitly said they are choosing scale, market dominance over immediate profit. Grow the pie first, then figure out how to slice it later.
Okay, let's push back on that inelastic demand idea, though. Sure, they're the main player now. But what happens if, say, Uber or Bolt decides Turkey looks interesting next year? Wouldn't keeping rates super low actually act as a barrier to entry?
Absolutely. That's almost certainly part of the calculus. The low take rate functions like a strategic moat right now.
Makes it unattractive for a competitor to come in and try to match driver earnings while still making money themselves.
Exactly. A competitor would have to burn a ton of cash to compete on price with Marti's current model. So the huge upside, the long-term bet for investors, is that Marti eventually does raise those rates towards the global benchmark, which is closer to, what, 30%?
Right. So the current strategy is basically buying an option on future market dominance and pricing power.
You got it. And maybe the most crucial financial insight they shared wasn't even the negative EBITDA. It was about the core business.
The original cities.
Precisely. They confirmed that their first 4 cities, Istanbul, Ankara, Izmir, Antalya, the established ones, They're already profitable on a contribution margin basis.
Meaning revenue minus variable costs and direct marketing for those specific cities is positive.
Correct. And that is critical because that internal profit generation from the core markets, that's what's actually funding the expansion into those 6 new non-monetized cities right now.
So the model works at scale. They're just reinvesting everything and then some into growing the footprint.
Exactly. The core engine is profitable. They're just pouring all the fuel back into growth.
And they have the cash for this growth phase.
I say yes. The $23 million in convertible notes they raised back in April, that fully funds this growth plan for the next 12 months at the current low take rate.
Okay. And what happens after 12 months?
Management said they expect to revisit that trade-off, raise more money versus finally start increasing take rates sometime in the next 6 to 12 months. So a decision point is coming.
Okay. If they pull this off, if they really dominate Turkey, how big could this market actually be? Did management put a number on it?
They did. They estimate the total annual revenue opportunity at maturity could be around $3 billion.
$3 billion? Just for ride-hailing in Turkey. How did they get that number?
They used New York City as a benchmark, basically arguing that ride-hailing tends to expand the existing taxi market significantly by about 1.6 times in the NYC case. Apply that kind of logic to Turkey, you get to a big number.
A very big number. Now, what about their other advantage, the fact they started with scooters and bikes, the super app idea? Is that actually helping?
Oh, massively. The data they shared on cross-pollination was, frankly, incredible.
Like what?
Get this. Somewhere between 70 and 84% of people who use their two-wheeled services first subsequently use their ride-hailing service.
Wow, huge overlap. So the scooters are basically an acquisition channel for the higher value ride-hailing users.
Seems like it. And these multimodal riders, the ones using both, they're gold dust. They generate 3 times more rides and 2.7 times more revenue per rider compared to people who only use one service.
That multimodal strategy seems really key then. Okay, a couple of other interesting points from the call. They mentioned crypto, Bitcoin.
Yeah, a crypto treasury strategy, basically holding some of their non-operating cash, their rainy day fund in Bitcoin.
Why? Are they becoming a crypto company now?
No, definitely not. They were very clear. It's not a new business line. It makes total sense if you think about their context. Turkey has really high local currency volatility, high inflation.
So it's a hedge, a store of value.
Exactly. They see Bitcoin as a way to protect some of their reserve cash, shareholder capital, from being eroded by the local currency devaluing. Purely a treasury management decision for non-operating funds.
Got it. And their take on autonomous vehicles, AVs.
Very pragmatic, I thought. Management basically said, look, AVs are inevitable eventually, but...
Big but.
Big but. They think it will take significantly longer for AVs to become economically viable in Turkey compared to, say, the U.S.
Why is that?
Simple economics.
Yeah.
The revenue per kilometer driven is just much lower in Turkey. So the incredibly high cost of AV technology today means it would take way longer to actually make money undercutting human drivers there. Hashtag this is not financial advice segment.
Okay. We've covered the numbers, the strategy, the market, the risks. Now let's pivot to the part of the show where we put on our speculative hats, the this is not financial advice segment.
Let's get outrageous but plausible.
Exactly. Purely theoretical trade structure based only on the information from this call. What's the pitch?
Okay, the core thesis here plays directly off that tension we identified right at the start.
Yeah.
Marti's choosing scale now over profits now. So the trade idea is two-pronged. First, go long Marti stock, MRT right now. Bet on the near-term catalysts amplified by the low float. Second, simultaneously structure a much longer-term bullish bet, specifically on them eventually flipping that profitability switch.
Okay, break down the short-term part first. Why buy the stock now?
Look at the chart action around the call. Stock spiked on high volume, but then went flat. That suggests maybe the selling pressure, perhaps, from people who got stock via those convertible notes has been absorbed. It found a floor.
Okay.
Now, combine that potential technical setup with two things. They have a $2.5 million share buyback authorized through October 2025. And, more importantly, that insane 107% rider growth.
If they hit those year-end targets.
Exactly. If they hit that 3.3 million rider target, maybe even signal strong Q3 progress towards it. The very thin public float on this stock could dramatically amplify any positive price movement. So the short-term play, buy the stock, hold through Q3 results, betting on scale execution and the buyback providing support.
Okay, that's the near-term momentum play. Now, the really audacious part, the long-term bet on monetization.
This is where it gets fun. You structure a long-dated call spread, let's say out to 2027 maturity.
Right.
Deep in the money, maybe? Or just significantly bullish?
And what's the specific trigger for this spread?
It's betting purely on management eventually doing what they say they can do, raise take rates. You're betting that sometime in the next 18-24 months, once they feel market saturation is good enough, they will increase that high single-digit take rate towards that 30% global benchmark to reach profitability and tap into that $3 billion market potential they talked about.
So it's a pure play on management eventually choosing profit over just scale.
Precisely. It profits massively if they follow through on leveraging the market dominance they're building right now. It's a bet on the second act of the story. Hashtag tag outro.
A very compelling, though definitely aggressive, structure. I think the key takeaway from this whole deep dive is pretty clear. Marti is moving incredibly fast, executing this massive land grab in a country that's been underserved by tech mobility.
Yep.
And they're funding it using the profits from their established cities while deliberately keeping that main profit lever, the take rate, way down to solidify their position.
Which leaves us with that final provocative thought for you, the listener, to chew on. We saw how valuable those multimodal users are, right? The ones coming from scooters.
3 times the rides, yeah.
So given that data, how crucial is that two-wheeled fleet, even if it's shrinking relative to ride-hailing? Is it just a legacy business? Or is it actually a vital, maybe even capital-efficient customer acquisition engine constantly feeding high-value riders into their main ride-hailing business?
A question that really gets to the heart of their long-term efficiency and strategy. Something to think about. Okay, that's all the time we have for this deep dive.
Thanks for tuning in.
We appreciate you joining us, and we'll catch you on the next call.